Now, overall, this year's IPO performance is a little reminiscent of 2019, but back then there were sort of these big consumer disappointing debuts like Uber and Lyft, and of course you had WeWork and pulling its own IPO endeavor as well. What's different this time around?
Yeah, I think there's some unique factors this time around. I mean, when we look at relative value, a number of these IPOs and technology companies in particular, which represent 40% of the IPO market this year, have come at historical peak multiples. Point one. Point two, we're at a different stage of COVID now. We're looking through COVID. We're learning to live with COVID. Some of these business models, COVID represented a significant accelerator, and investors now are looking through, and I think there is an element of a COVID cliff. Can these business models continue at the rate and pace that they have during COVID in this new era? And then finally, I would say we're at an inflection point as it relates to inflationary concerns, future rate rises, and investors started to question, will there be a fund flow rotation into more cash flow cyclicals and away from just sheer growth?
Right. Certainly, a different environment this time around. We've seen more direct listings, certainly, and they've also sort of underperformed. But the key difference there is that insiders, early employees are more able to get their money out. And for some of the big IPOs that haven't performed very well, those are the ones that have been hurt most. Do you think that as we see this sort of disappointing performance of the market as a whole, we see more direct listings going forward?
It's an alternative for sure. And issuers have more alternatives today than they've ever had in the past. Obviously, every company is situation specific. Companies either need the primary capital IPO and therefore need to go that more traditional path, or if they don't have the primary need for capital, then the direct listing is available to them. Certainly, it enables liquidity day one. Having said that, in the traditional IPO market as well, we've seen a lot of innovative structures, triggers to allow secondary release through lockup mechanisms based on aftermarket performance. So the traditional IPO market has evolved, and direct listings obviously do provide an alternative as well. But issuers have, a lot of different paths they can go with when it comes to relative value. So traditional IPO, direct listing, potential combination with a SPAC, or an outright sale, or stay private for longer. And when we look at the private capital market formation this year, $800 billion has been raised. That's an area where Citi is very, very focused. And I think while we see this volatility in the IPO market, we may well see great companies just decide to fund privately and then come to the IPO market in a healthier window.
Yeah, Phil, looking specifically at a couple of the names coming public soon, Samsara and HashiCorp, both very much of the moment, multi-cloud and cloud logistics. But I wonder if you think in this environment it's that initial IPO pop that's most at risk, or is it how the companies themselves are likely to be valued? And maybe it's not such a bad thing if we don't get those enormous initial run-ups like we saw, say, in C3 AI.
Yeah, I think you're right. I think it's the IPO discount that's getting questioned today. We did see some very, very meaningful pops in day one. And that is something that is more characteristic of US IPOs than IPOs around the world. If you look, at IPOs in EMEA, they don't tend to have that same day one pop. They tend to be larger floats that come market. So you get a more seasoned aftermarket. In the US, we tend to have smaller floats, potentially even less than 10%. And that starvation of liquidity can cause a greater pop in the aftermarket relative to the oversubscription in the book. So, yeah, I think investors moving forward will be more price sensitive, given the aftermarket performance we're seeing today, will be more selective, and I think won't feel the need to chase the IPOs in the aftermarket. So we may well see a more normalized pop. We still want to see positive trajectory, but it may be a more seamless appreciation over time rather than the volatility that we've seen more recently in some of these US IPOs.